Hi guys, thanks for tuning in to another episode of Nuggets News. Well, I want to do something a little bit different today and just go off the cuff, really going over what is happening in the real economy versus the stock market. So I'm going to touch on all those different asset classes, tie everything together because there is so much going on. You've probably noticed my market update videos are now going 40 or 50 minutes, whereas they used to be 30 minutes, I think in the middle of crypto winter where there wasn't much crypto news happening, they'd be maybe 20 minutes. So there is a lot happening, and the details, I guess the nuances are very important to understand, and it's all happened very fast over the past few months. So if you go way back to December, when we first spoke about COVID and what it was and how I thought it had the potential to become something far more serious because of its characteristics, and how I really held back all the different theories that were being thrown at me, and they're still being thrown around in the comments, because now we do know a lot more. And I think it's important that we strike a balance of reopening and letting people get back to work to some degree once we know it is safe. And life is going to change. People are going to wear face masks, social distancing, washing your hands. Those kind of things are probably going to be with us for good, because we are seeing the rebounds in some countries, and that's what we want to avoid. Now, certain things, large scale events and mass gatherings, they're probably further away, but I'll leave that up to individual countries to decide how they want to go about it. And it is an experiment. We're going to see who does what well, what works, and what doesn't. But let's dive into, I guess, the financial side of things. So I think it was January and February, I was making videos about how the parallel universes had really diverged. So the stock market was just ignoring what was now happening in the real economy. And with the debt loads around the world, it wasn't really COVID that brought markets down. We've been speaking about this for years. It's the systemic, the underlying, look under the hood, particularly in Australia. I did our documentary going over that in great detail, and things like household debt. So all that has now come to the forefront of the discussion, and it's almost been incorporated into the bailouts and the fiscal policies of governments, what central banks are doing. They've kind of got this, get out of jail free card because what has happened with the COVID side of things. So I think it's really important that we differentiate the two, and we are seeing some discussions already around corporate bonuses and inequality. If you've been following me on Twitter, there's some fantastic articles coming out, even from more of the mainstream sources, now questioning what is happening in the world with the companies that are getting bailed out for the second time in a little bit over a decade, and central banks really being out of ammo, which is what I want to get to. So once again, stocks have bounced really strongly. We were very lucky. I made that video called "The World Has Gone Crazy," something like that, and that was 48 hours before the markets had actually crashed. So I know a lot of you were already getting into more defensive positions, and before that we were talking about how QE and money printing, as long as it kept happening, it was going to drive up markets, and it only just started happening in Australia, the rate cuts, and what did markets do? Break out to new highs. But then we did those videos outlining how things had really changed. We saw the number of retail investors piling into these zero-fee trading apps just go parabolic, and it's still the case. They've actually been buying this dip, which isn't good, which makes me think it's going to roll over again. So throughout history, when we have these stock market crashes, the initial leg down, we often get a bounce, and there's been a lot of good market commentators talking about this. The guys over at Real Vision and Raul, who I've become really good friends with, they've got a special on at the moment about what comes next. I think it's only $1 for that trial to join. So I recommend you watch all those videos. It's very good value, and I'm going to make my way through all those this weekend. I've also got a video coming up with Brent Johnson, who talks about the US dollar milkshake theory, and I'm building my own thesis around how stablecoins are going to play a huge role in what is going on around the world with the US dollar shortage. So a couple of days ago, we did a video with Marika Tusa. Again, we're so lucky to get access to these leaders, these thought leaders in their spaces, and I get to bounce ideas off them and say, do you know this is what's happening in the crypto space? With Brent Johnson next week, being able to educate him on how all these different stablecoins work and at what point the technology is now at, I really think it's going to blow him away. Someone that knows all about the the US dollar from the financial side of things. And when I get to get these guys up to speed on what is happening with Ethereum, stablecoins, smart contracts, they're blown away. And I think tying this all together, and I don't want to give too much away, but we do have some very special episodes and series coming out to educate the world on how this stuff works. So very much looking forward to that. And the doors that have opened this year are just unbelievable. So for those of you that are relatively new to the channel, we were a very small channel and we didn't do clickbait headlines or, these coins of promising going up 100x and which one's going to get you rich and putting moon in the title of our videos every second day. And I think that's attracted a really mature audience, and that's really paid off, I guess, in the long run. So we've accelerated past 80,000 subscribers. In our premium content, we just passed 1,600 members, which is a record, surpassing 2017. So these are all little milestones that I had personally, and the team are just brilliant. We've put on some more content creators. So the research that you guys are getting emailed to you every day, the reports, the gold and silver, we are getting the experts in their fields to join the Nuggets News team in a full-time or casual capacity to produce these products and help Matt and I write them, and with all the research, filter that down to give you guys the best content, particularly members, but also to help me stay on top of everything that's happening and get out the Sunday videos and the free content for you as well. So let's talk about what is happening now and where I think things are going. So I think stocks have had this bounce. I do think they're going to roll over. We've had a few good short trades actually from the 61.8%, that golden zone, which I love. It tends to happen over and over again. And if you know your Fibonacci numbers, you might find that interesting as well. But the corporates and the cash flows and the earnings have been pretty bad. It's sort of the top 5 stocks, the Facebooks, Amazons, Netflix, Google, a couple of others now. So, Microsoft as well. There's a few other of these tech stocks that are benefiting from this work from home, digital, online, gig-ish economy that's sort of changing before our eyes. And it was probably already changing, but COVID's just really accelerated that. So there are some stocks that are doing well. They're taking up a large chunk of the index, and that's kind of disguising what's actually going on with all the small businesses. And if you look at the stats, I think it's something like 50% of US businesses have said that they're running out of cash or that they're not going to reopen. So governments have directed this support, and different countries have had different approaches, but directed it in a lot of ways towards the banks, and then say, well, you've got to give out the loans. We're happy to spend this. Or the Fed have said, we're happy to print this money, but giving it to the banks. And the banks still have to make decisions about loans. And a lot of the banks, particularly in Europe, where they're hurting already, are being really protective and adding capital to their reserves. Even when sometimes the central bank have said, well, you don't even need the reserves. You can scrap the reserve ratio or the fractional reserves altogether. You don't need anything now. We're happy for you to have zero for your lending. Now, that's a little bit different to some other aspects of the bank, but we won't go into that today. So basically, everyone is being very cautious with their lending. They don't want to risk giving out more money and having more failures in 6 months' time when some businesses might not reopen. So why give them a loan just to pay their staff if they're going to fail in 6 months, and that's going to end up as a bad debt on your books? So this is, I guess, the dilemma that the banks are in. Now, that is still free money, so it's not like the banks are crying poor, but there are those structural issues. Now, personally, I would have liked to see governments, if you're going to tell people they're not allowed to work, you have to support everyone. And there's 1 million plus people that have fallen through the cracks in Australia. And I've got a lot of friends that work in the music industry, for example, the gig workers, people that are casuals or part-times in specific industries, that work at big conferences, sport, those type of things that have been left out or fallen through the cracks if they don't fit those, those new criteria. And even if you've been in a new job for 11 months, it doesn't matter if you're CEO, you don't get that, support in the short term. So if you're going to tell everyone they're not allowed to work, I think you need to support them and do it directly. Again, don't give it to their employer. And we're starting to see cases of fraud, hearing stories of bosses saying you've got to work more or you've got to do this or that. I'm only going to pay you a certain percentage. So yeah, there's a lot of issues. Hopefully there's not too many of those and people, karma goes full circle and then we'll be able to sort it out in future. But I think why not just do it give it to people directly. And Australia is one of the few countries where you can do that because of the way we collect taxes in our system. Now, in other countries, it's a bit harder. That's why in the US, they've got those different ways to do it. And some people are still waiting on a paper check in the mail, which is crazy to think. I spoke about my theory there, how everyone could easily download a crypto app, or in America, just get everyone to sign up to Coinbase, register, give them USDC stablecoin. Maybe that is in the pipeline. I think Coinbase recently hired someone that's ex-government and working on these payment systems. So there's a lot of overlap there. You can go down the rabbit hole and talk about Microsoft and Bill Gates, and if they're trying to tie in a lot of this stuff with the digital identities as well as the digital payments platform. But either way, we're going down this route of privacy, surveillance, all being really used as the excuse, blaming COVID. We need to do all this thing. We'll wait and see how that plays out, because I'm a big believer if we can get things back to normal, we can really push back and say, well, no, we don't need to go down that path of the total surveillance. That's not necessary, but that's a conversation for another day. So that's the world of stocks. Earnings are down. The valuations are now up. The really smart minds, Stan Druckenmiller, Ray Dalio's of the world, everyone was jumping up and down when Warren Buffett all of a sudden said that he'd sold his airlines and stocks are a bit overvalued. He doesn't see a lot he likes. But the fact is that that was probably the case for a long time, and markets were perfectly priced, looking ahead. Whereas the reality, once again, was 90% of the gains in the last few years, I think it's the last 5 years, don't quote me on that stat, but that all came from that money printing, the low interest rates, corporates, businesses borrowing money to buy back shares, to meet these fake targets. No one is reinvesting in their own business and expanding. It just became all about that number on the screen on Wall Street to get your bonus. And that's, I guess, a different kettle of fish in Australia slightly, but the same concept, where so much money goes into our housing and construction, and they're all in the banks, and that's all makes up our super funds. Everyone has to put 9% into their super, and a lot of that's concentrated in Australia still with the investing side of it. So that's what kind of worries me there. Banks that should be lending to businesses or startups, individuals that are putting 30, 40, 50% of their salary into a house, a mortgage for 50 years, that is not productive investment compared to other countries where people might put 20% of their salary into their rent or their mortgage, and you've got that extra 30% to go out, spend with friends, start a business, have another hobby, and that money's going more dispersed throughout the economy to different areas, and it's not going to the banks for the next 30 years of your life. So that's a few thoughts on what's happening there. Now, in the bond market, when stocks started to crash, a lot of that money had already been going to bonds, the safety of bonds. The smart money goes there first. And I do a lot of write-ups in our group about this. Watch the bond market, the smart money. Because all throughout this rally, this bounce in stocks, bonds didn't sell off. So the smart money wasn't rotating back into the stocks. They were staying in those bonds. And that's very, very telling. Now, there's been a lot of demand for US dollars. Sorry if you can hear Henry barking in the background there. The joys of COVID, when you've got the baby at home and the dog. You've probably heard them in the background of a few podcasts lately. So getting back to bonds, the US dollar is the other place where people have gone to for the safety. And globally, there's just a huge demand. The day that the Aussie dollar crashed down to 55 cents, we must have received, myself personally and the Nuggets News support staff, hundreds of messages of how do I get out of Aussie dollars, or how do I buy US dollars? So you can think of that as selling Aussie dollars if you're buying US dollars. And to me, I did a video at the time and a write-up for our members saying this is what a capitulation looks like. And if I want to put my trader hat on, I'd probably buy here. I want to do the opposite to what the herd are doing, because there's going to be a bounce. And look what happened. There's been a 10 or 20% bounce from 55 cents back to, I think, around 65 cents. I do think longer term, the Aussie dollar and the Aussie economy is in for a lot of pain because housing is going to roll over. Commercial real estate in Sydney, the figures out now are telling us that the vacancy rates have doubled in the past month. So people don't need to travel 2 hours to work in the CBD on these crowded trams to go up in 30 stories in an elevator, to sit at their office cubicle all day. So maybe that's, I guess, a bit of a over dramatization, and not everyone does that, but that's that general thesis where people are saying now, well, I'm going to work from home. Jack Dorsey of Twitter just told all his staff that they can work at home for good from now on. So that's, again, it's just one case, but we are going to see that to some degree. And maybe it's not your whole staff. Maybe it's 20 or 30% of your staff, but it's going to make a difference. And it's going to change the sentiment. And you're probably sick of me saying this, that sentiment is what drives markets. It doesn't matter if you're a trader or an investor. Look at the Australian property market. It's just that sentiment that it is ingrained in our culture. So in the startup world or in the business world, it was that sentiment where everyone wants to be in the CBD. Everyone wants to feel important and pay that expense for that office building. But once that changes, it's even a demographic, a generational thing. It can take a long time to get back to that. We might have this shift where people value their time more and they are happy to give up that traveling time and that rent expense for maybe that slight less efficiency of not being able to work with people. There's all these trade-offs, and I think people might maybe change what they put more value in. And if COVID has a flare-up, it's maybe what is safer for your health, not going out and doing that travel and packing into a bus or a tram every day. So the times are changing there. But particularly the bond market. So a lot of these commercial real estate, like we're just talking about, as well as residential real estate and people that having to live in the city, Airbnbs for business travel as well as holiday travel, they're the things that are now experiencing the vacancy rates and decreased cash flow. So in terms of the bonds, the corporate bonds, they are being hit. That is a bloodbath that is waiting to happen. And that's why I think I made a video saying that the Fed are going to have to step in, because that can cause a cascade that can spread out and start a house of cards effect and could collapse the whole corporate bond market, just like we saw the CDOs, collateralized debt obligations, caused the collapse in the GFC. The CLOs, collateralized loan obligations, where all these different loans from companies are packaged together and sold to other investors. That has the potential to really cause this market to have another leg down, 50, 60% correction. And the Fed stepped in, I think it was the day after I did that video, saying that we're going to buy junk debt and we're going to buy junk bond ETFs that have all these CLOs packaged in them. So the Fed are trying to patch all these holes, these leaks in the financial system as they spring up. And it's a bit like whack-a-mole. There's only so long you can do that. So with oil prices the lowest they've been, the whiteboard video we did talking about the cash flow of all those companies where there's been overinvestment because there was too much money at a too cheap a rate. These companies could just roll over this debt. Everyone wanted to lend to them. Banks, investors, give more shares, give more bonds. Everyone is happy because you're paying out this 6 or 7% return. And if it comes time to pay that and you don't have the money, you just borrow more debt and you roll that over. And that's why that corporate debt, if you look at it, has just exploded in recent years. Now that's that side of things, the commercial bonds and the junk bonds that they're trying to save at the moment. But it's also the government side of things with the government bonds. And this is the final penny to drop. The US dollar is just at the center of the financial universe at the moment. So the US government bonds still had a yield of 1 or 2, 3% on a 10-year bond. Now, in Europe where it's zero or negative and everywhere else in the world, investors were giving all this money to the US. So even if the ECB printed money or Australian QE printing money and giving it to the banks, a lot of the time they'll just use that to speculate and go buy US bonds. So it doesn't matter how much money some of these other countries print. In a lot of ways, it devalues their currency, but it still ends up going to the US and speculating on US stocks or bonds. And now, similarly, the Fed are printing a lot of money at the moment because there's so much US denominated debt outside of the US, the euro dollar system, as you've heard it called. And they're scared that they're printing trillions of dollars. They're worried about causing inflation. You're printing $2-3 trillion, and then Trump and government have got a $2-3 more trillion fiscal program that they're going to spend. So they're really worried about inflation. But really what's happening is a lot of these dollars are just going outside with the swap lines. Marin Katusa and I talked about this in the video. These other countries that rely on US dollars for paying their debts, paying back loans. Commodities are all priced in US dollars. So this all intertwines, and this is why I feel so privileged in the position, getting to watch different videos, talk to different guests, tie this all together, and it is very, very important for Bitcoin, for stablecoins. Now, I think stablecoins are going to surpass the market cap of Bitcoin, and that's a bit of a crazy statement. The purists are going to hate me for that, but look how quickly it's grown from $1 billion or so of Tether to $10 billion now of stablecoins. And that, to me, lines up with the huge demand we're seeing for US dollars. So in crypto land, we're talking about billions of dollars demand, $10 billion of US dollar stablecoins. In the real financial world, to use round numbers, we're talking 10 trillion of US dollars that are needed outside the US to pay back debts. Now, in America, we know that it's way bigger than that. We're talking $100 trillion of unfunded liabilities. Just the other day, the Fed had to give out a loan to a state because they can't pay their concessions, their employment benefits, the food stamps, and the pensions is the other thing. So they're having to now bail out those areas, let alone spending on all the other government programs. So governments are going more and more into debt. They're running the biggest deficits ever at a time when we are not in a recession yet, let alone if this turns into something worse than just a regular recession. I think it was the Bank of England said that this is going to be the worst downturn we've had in 300 years. So if that's true, what are they going to do with rates at zero or negative? And they've already played their card and printed a lot of money. That's what's really worrying. That's why we're getting into these talks about modern monetary theory, a global debt reset, a jubilee. What do you do? How do you fix this problem? And at the center of all of it is the US dollar getting stronger no matter what, because of the way that it has just, made itself so crucial to every other country in a way that they didn't think was possible at the time. And that's where Bitcoin has a huge opportunity to be this politically neutral currency. Now, at the moment, it's too small. The market cap is too small. So I'm working on a few other pieces and theses, write-ups and research that we're doing. But I think once Bitcoin has greater liquidity and people can go from the bond market or US dollars or stocks into Bitcoin with big trades, we're talking tens or hundreds of billions of dollars for fund managers. Once Bitcoin has that liquidity, I think it becomes a really legitimate, useful asset class in the eyes of other players, as well as all its other great properties. And in this world that is digital and 7 days a week, the fact that markets only trade 5 days a week, 10 till 4 in Australia, for example, all this is going to change. You can't keep having that system in a world that's just so globally interconnected. And that's where Ethereum and DeFi really come into it. And we're seeing some just awesome projects in the derivative finance space that Anthony and I cover each month in our episodes, and we cover in our research reports and my daily write-ups in our members group as well. So that is the Eurodollar system. That's the US dollar. That's the debt. A lot of people have also been going to gold. Gold, as I'm talking now, is $1,735 an ounce. In Aussie dollars, it's getting up towards $3,000 an ounce. Insane to think that this is happening, and it's only really getting started. Silver's been playing catch up a little bit, back to $16 today. I don't want to talk about gold to silver ratio too much, but that is the big main asset classes where investors are playing around. Now I want to get to the inflation versus deflation debate, and that is the question on everyone's lips. If you can get this right, it is the investment theme for the next 10 years, how you want to position yourself to make money. So one argument is that you print all this money, you're going to have inflation. But that's also what they said after the GFC. When I went down the rabbit hole and people were talking about buy gold and silver, silver's going to $600 an ounce and gold to $10,000 because they've printed billions of dollars. That never happened. The silver price and the inflation, it didn't happen. So what did they get wrong? Well, the money didn't get into the real economy. It only went into financial assets and increased the reserves at the banks and CEO pay. That inequality, you've seen some tweets recently, CEOs now getting paid, I think the average is 300 times more than the average worker. And when you take into account inflation, the average worker's wage has only gone up 12% since 1978, I think it was, the last about 40 years. So that inequality, all that money, the whole financial system, you can think of it as whenever we push money into the financial system from the government or particularly the Fed, because it goes through the banks first, they get all the reward. They skim their fees, they get to spend it first. There's so many privileges that the banks have and the US dollar has. So that's why the US financial system has such an advantage over everywhere else, the rest of the world. There's other things that come into play here in terms of having a good economy, but there's just no way that you can compete with what the US has as long as they're in that position where they can print money and not get inflation, and the rest of the world need their currency. So the other aspect here, the other end of the spectrum, is deflation. And what that means is that things are getting cheaper. Everyone is spending less. When people are scared or having a stock market crash, people don't go out to cafes. A lot of people are even selling their shares and their other assets. Boomers that want to knuckle down, and they get all that money and they keep it in a savings account and they don't spend, and they start to save. This is also the unintended consequence that we've seen in Europe with negative interest rates. So they thought that in theory, you drop rates, people spend money because they can't save it and get interest. Then they went negative and they wanted to penalize people. Spend your money or it's going to go down. But the opposite happened, where people said, well, now I'm not getting that interest to live off each month. I need to save more. So it's almost like everything that is happening in the textbooks of the Fed and these other economists, it's just not true. It's not how the real world works. Their models are wrong. And this is what Steve Keen, love him or hate him, he's got some interesting theories, and I don't agree with a lot of them, but that is one thing he's got right, that he's spoken about for years, that we're going to get to this point, and the Fed don't understand. They can't see these financial crashes coming because they don't allow for things like banks, debt, or money in their own models of how the economy works. They're all based on availability of credit. Now, credit is also less available, as we touched on before. No one wants to lend and go into debt. Banks are hesitant to even give out loans, and a lot of the businesses or individuals that are going in are being told, no, we're not actually giving you a loan. So that's the inflation versus deflation problem. Now, where we're currently at is the government increasing their fiscal spending and trying to tie people over or build this bridge until after COVID. Now the debate has changed to, well, how long do we need to keep it going? And who's going to pay for all these debts? In Australia, they almost reached their beloved surplus that they're striving for, and then they had to spend huge. Now, in other countries, they've already got these huge deficits, multi-trillion-dollar deficit in the US it's going to be this year, and they're ramping up this spending. So people have become reliant on the government. There are people that are making more money getting government benefits now than they would working. So they are in no rush whatsoever to get back to work. So the government's fitting the bill, giving people less reason to go back to a job. That's why they want to get rid of it. In terms of the Fed, they already basically played all their cards. They've printed trillions of dollars, rates are at zero. They've said they don't want to go negative. But the market is now pricing in everything that's happening around us and saying that things are heading lower, rates are going negative. Now, remember when Trump was tweeting at Jerome Powell saying that we need lower rates, we need to go to zero, we need to print money, other countries are doing it. And Powell was saying, no, I'm doing my own thing, I'm independent. Well, Trump got his way. And now the Fed, the government are giving the Fed more roles and permission to do certain things like hire BlackRock and buy junk bonds and ETFs. It's almost like Trump is kind of in charge of the Fed or has more power now. So when he's now tweeting Powell saying negative rates, Powell says yesterday that it's not happening. The market is pricing that in. Trump is going to get what he wants, whether or not that's a consideration of Powell. The market tends to be right and the Fed tend to be wrong on every turn. Literally every time they say something's going to happen, the opposite tends to happen over time. So there's a reliance on the Fed and the QE and the money printing to keep stocks afloat and asset prices up. And maybe they can do that. Maybe they print so much money that stocks go to new highs. But it doesn't make any sense with 20% unemployment. Doesn't matter. They're parallel universes, and that's something that's really important to understand. But the magnitude of what they're doing is what's scaring them. So governments don't want to spend more. They are really worried about inflation, and the Fed are paranoid and petrified of inflation. If they get it, when rates are at zero and everyone's got all this debt, what are they meant to do? Do you raise rates to 5% to stop inflation because you printed too much money at a time when everyone has got record debt? Companies, the bond market, the junk bonds that have issued 10 trillion, households in Australia, credit cards, everything. Can anyone afford to pay 5% rates? No, so you can't really raise rates. And then inflation gets out of control and we end up with the Venezuela, Zimbabwe type situation where food, goods, that sort of thing, rent, health insurance, that's all going up. But there's high unemployment. People don't have jobs. People aren't making more money. So you're getting inflation, but you're also getting the deflation of what's happening around you that the central banks are fighting, because you've got, retirement, demographics, those things that we've spoken about, they're kind of against you. So the Fed have put us in this place. Monetary policy in general, I think you'd argue that even economic models, government, banks, the Fed, the central banks, basically have all got this wrong. And it's been about perpetual growth and more, rather than talking about sustainability and is this good? Should we be thinking longer term? Should we be encouraging 20-year-olds to get 5% down mortgages and $1 million? Is this normal? Well, I think we're going to look back and argue that we were all a little bit paranoid or brainwashed. Or I just talked to my grandfather, and he's been pretty unwell lately, and I'm hoping to do an episode with him, but he's fighting cancer at the moment and not up to having that chat. But we talk about how money's changed over the years, and when I say something like that about being brainwashed in terms of investing in housing, it's a generational thing. If you had have said to someone 2 generations ago, do you save up to buy a car or a fridge, or do you go into debt to do it? And it would have been unthinkable to go out and buy all these different luxury items that you can't afford and to live beyond your means. So we often, the young people these days and social media, and people think someone's successful with a good car and a big house and tweeting about trading every day, but really underneath all that, they're probably in huge debt. And the guy that lives in the small house with the small car and the family, they're the sort of things that I guess make me happy, and what I think more people would actually realize is going to make them happy in the long term. And having financial freedom, not being indebted, having flexibility. Do you have a hobby, and do you have a way to earn income on the side if someone loses the job, the rainy day fund, those type of things? So that's where we're currently at in this situation. A huge magnitude of what everyone's having to do to kick the can down the road. Banks freezing up and not willing to lend to each other. I think that was kind of showing the real interest rates when they spiked to 10%. What are the interest rates in the crypto world for US dollars? They're around 8 or 10%. That's what you can get for lending. That's what the repo market was telling us it's going to cost you to borrow US dollars until the Fed stepped in. So we're starting to see the cracks in what things are really worth. I think that's a lot lower for a lot of these stocks and companies. I think for bonds, it's a lot lower. Why are people paying a record amount for a negative yielding bond? Once the US and their bonds go negative, it all ends. People don't want to park money there, something that has a negative yield or a negative bank account on their US dollars. And that's when the trillions, tens of trillions of dollars, all of a sudden it has to park in something else. Gold, I think Bitcoin, I also think these stablecoins are going to play a role to some degree. Can we have a negative yield? Can we have a basket of stablecoins to avoid that negative yield? Do we have these other coins that are pegged to gold and silver, driving up the demand and getting rid of these ETFs, futures and paper products that are backed by real gold, now that there's a huge demand for physical gold, and these banks and these brokers can't make good on these promises to actually deliver the real deal. So that's the way that I'm seeing things at the moment. If you had said a few months ago that negative oil prices were going to be a thing, negative $50, people wouldn't have believed you. If you had said that Australia and China would be having a bit of a trade war, slapping tariffs and threatening each other, would people have believed you? The US and China are basically back at it in terms of who started, who's to blame, and the trade deal's off. And there's billions of people around the world that are living in countries where trade has broken down. The supply chains are experiencing enormous friction. They're not going to be able to get food and goods that they want. So that's probably going to push up prices. Again, that's select inflation at a time when they're also experiencing deflation. How do governments fight it? Those small governments can only try to print money. That's why their currencies are going down in record amounts. And these people, billions of people, now have a smartphone and a way to park money in something else other than their local currency that is just devaluing or hyperinflating away. And this is a world first. We've got high smartphone penetration and the digital age, all these apps where people can get access to a finite currency of gold or Bitcoin or some of these other stable coins and earning mechanisms to earn a little bit rather than to get penalized with negative interest rates. So a bit of a long one today, guys. I've been speaking off the cuff. I don't know how long that went for. I'm sorry if it ran a bit longer than normal. This is really important stuff. I talk about this every day in our group. So head over to nuggetsnews.com.au if you want to join us. Otherwise, share this one around with friends and family. Hit that like button. Subscribe if you haven't already. And I'll talk to you again soon. Cheers.